What is the bond market telling you right now?
Sure. So I think the bond market is clearly in the recession camp. I mean, the flattening of the yield curve, the inversion of the yield curve, the fact that the 10-year has gone from, well north of 4% to now even below 3.5% over the last month. I think the market has been grappling with a couple of issues. I think number one, the Fed suggesting that they can slow down the pace, I think has improved market, I think, perception of where that endpoint of the hiking cycle is. I mean, we're debating 4.75 or 5.25. So I think there is some greater understanding of where the Fed might stop. But I think if you look at the long end, the fact that that's leading is the market pricing in a recession sometime by the middle of next year. I actually do think that we're going to head into a recession. So I think some of that move is justified in the long end. I do think it's a little early. The data is strong. I think the consumer is resilient. I actually see that slowdown happening more at the end of 2023, but I think the market's forward looking and it's pricing in this recession, the
Uh-huh.
lagged impact of everything that the Fed has already done.
Well, not all recessions are created equal, are they? I mean, you've got the Great Recession of the financial crisis. Then you have, 1990, where you had a downturn, but it was relatively brief. So what do you think? What do you think about the economy, and what do you think the bond market is saying? Not about the recession, but because that's probably baked in, but how severe and long it might be, Priya.
Right. So I think I would agree with you. I think it's more likely to be like the 1990 recession or the 2001 recession, shallow, because we don't see the same sort of leverage in the system that we saw in 2008. So it's likely to be a more shallow recession. The bond market's pricing in about 200 basis points of rate cuts in 24. But where I struggle a little bit with is the length of the recession. I think there's a view that it's going to be a short, shallow recession. I think the Fed might be really constrained. I don't agree with the fact that the market's pricing in rate cuts at the end of next year. I think we're hearing very clearly from the Fed, if inflation is not at 2%, they're going to struggle to provide any policy support. So while I think the Fed will be forced to start to cut in 2024, it's a little early for the market to be pricing in rate cuts next year. So I think it might be much longer lasting recession than what the market's pricing in. And that's going to be really difficult for the market to absorb, because we're used to that Fed put. We're used to
Mm-hmm.
fiscal as well as monetary support. And I think the inflation backdrop, because we expect inflation to be pretty sticky on the way down because of wages, because of service inflation, that's
Yeah.
going to really constrain policy support. So I think we might be in for a tough 23 because we look for that policy support. And I think the Fed's going to say, no, we're resolute. We still have an inflation problem.